Good morning. Today is feedback day. Today is Wednesday, December 14th, and it's all eyes on the Federal Reserve. The Fed meeting will, the announcement will be made at 2 p.m. In that will be what the new Fed funds rate target range is, which is really expected to be between 4.25% and 4.5%. So essentially, they'll say raising rates to 4.5%. From 4% right now, that's where the expectation is. And then they'll also come out with what they call dot plots, and that's basically where the Federal Reserve expects the Fed funds rate to be at the end of 2023. Last time around, that was at 4.6%, and I think it's widely expected to be right around 5%. When it's revised this month. The last time we got those dot plot projections was in September. So Tom, I'm going to toss it to you. Talk a little bit about where the base case market sentiment is right now. And then we'll talk into your opinion.
Pulling it up right now, making sure I got the most updated numbers because we were bouncing around quite a bit yesterday. So at present, we're looking at a terminal rate topping out right at between 4 and 4.25 at the middle of next year. So, I mean, we're looking
four hikes.
4 hikes. Sorry.
So that would be around 5%.
5%. Correct. Yeah. So five would be the terminal rate. You know, we're down from, I mean, the expectations were as high as probably 5.5 as recently as 2 or 3 months ago. I think the message we're going to see is what they've been saying all along. And, you know, I'd be interested to hear your thoughts on whether or not yesterday changed the narrative enough on inflation to change the Fed's mind. But they basically said in their last press conference, don't confuse slower with lower, which is to say, just because we're not doing 75 basis point hikes every time doesn't mean that we're not going to continue to raise rates to a level that most people are currently uncomfortable with. Because basically 2 weeks ago, I mean, Bullard basically said 6 to 7%. There's been a number of Fed chiefs that have come out and said, hey, we're looking between 5, 6, 7% on the terminal rate. And right now we're seeing that number come down, and we're seeing it come down on a daily basis. And I think that there's a possibility that the Fed, Jay Powell this afternoon, and the dot plot and all the data is going to show that they still expect that terminal rate to be higher than people expect. And if that's the case, we're probably going to see bond sell off. We're probably going to see equity sell off as well. And I think there was a little bit of that turnaround yesterday afternoon, which was at first, there was just mass euphoria, right? Everyone's like, oh my gosh, this number came in so low. You know, the Fed's basically going to stop. We're going to pivot. But we've seen that time and time again. We've seen the expectations be behind time and time again. The question is, have we defeated inflation? Has the Fed decided that they don't need to raise rates? I mean, if you look at the way futures are indicating now, they're basically going to hike rates 3-4 more times and then immediately turn around and cut them 3-4 times. So we basically will end up at the end of 2023 where we are right now. The question is, do we even need to do that? Do we need to dig a hole and fill it back in, or are we just going to continue to dig the hole even deeper than people expect?
I think what the Federal Reserve is, I'll tell you what I think the Federal Reserve is going to do. Kind of the base case is the market expectation. I think that they're going to, and this is according to ING, they expect the Federal Reserve to raise by 50 basis points to 4.5%. And then they'll move that 4.6 number for 2023 up to 5%. But they're going to then forecast lower rates in 2024 than 5%. So hiking up to 5% and then maybe down to 4.5% in 2024. That would be the market's base case expectation right now. I think there's a very good chance that that's what the Federal Reserve does. And I think there's a very good chance that the market takes this as a positive. And the reason is, and I really want to be clear with what I say right now, because there's a distinction that I'm going to make between how the market interprets what the Federal Reserve says right now and what our internal expectation is for what will actually come to pass. What the market's reaction is, I think, is likely to be more dovish than hawkish. I think Jay Powell wants to pat himself on the back, say that they're seeing some good progress, and I think he wants to take a victory lap. This is a guy who has a big ego, and he wants to demonstrate that he is that they acted very aggressively, and he said that a couple weeks ago, and that it's having an impact on inflation, and that inflation's coming down and it's trending in the right direction. There's a lot more work to be done, but they're making good progress. They're going to continue to hike rates. I think that's what he's going to say. And I think the market's going to think that, take a deep breath and say, it's okay. Jay Powell's back on our side. He might keep raising rates, but he's not going to keep surprising us with 75 bip rate hikes. I think that's how the market's going to react to it. What actually I think will happen is that I'm concerned that inflation will remain persistent, that wages will remain high, and that service inflation will continue to grow, ultimately requiring Jay Powell to, what I call, pivot to pivot, basically have to reinflect his forecast for rate increases.
Yeah, I think that, to be clear, I think the narrative probably is going to come out today that we've mission accomplished, right? But we've seen all along the way that that's not been true. I mean, if you look back to expectations, and Jeffrey Gundlach, who's a big bond manager managing DoubleLine mutual funds, was saying yesterday that if you look back at what Jay Powell said in the middle of last summer, it was that inflation was going to be at 2% by the beginning of 2022. It's now about to be the beginning of 2023, and core inflation is at 6%, not 2%. So anything the Fed says is purely, they're signaling what they want to signal, but the reality is such that inflation is 3 times as high as they expected it to be a year ago. And sure, there's been some progress made, but, I think that they're going to have to continue to get that rate up. They're going to have to get it higher than core, so if core is 6%, they need to be at 6.25. How many hikes is that from here? That's probably 8 or 9 to get to a point where we're actually having an impact on that and can bring down core inflation. So, there may be, unbelievable euphoria. We might see the markets go up a ton today because he said, mission accomplished, he did a great job. But at the end of the day, 6% inflation, when we hit it the first time, was transitory, not to be concerned with. Now here we are 18 months later, we've just now gotten back down to 6%. So I would take that with a grain of salt.
The press conference begins at 2:30, and I'm curious what you think the point of emphasis will be, Tom. I believe that if Jay Powell actually talks more about inflation, because it is trending downward, I actually think that the more he talks about inflation, that will be taken dovishly, because inflation is actually trending in the right direction. The more he talks about employment and how tight the employment market is, I think the more that will be taken hawkishly, because essentially he will be implying that there needs to be more slack, there needs to be more risk in the jobs market in order to bring down those wages. So I think that will be the clear distinction that I will be looking at. Maybe the market will be looking at, maybe it won't. But if Jay Powell focuses more on inflation, I think that will be dovish. And if he focuses more on employment, I think that will be hawkish. What are your thoughts?
I 100% agree. I mean, the biggest stumbling block for him so far is the fact that the jobs market has not really budged at all. And the easiest way to slow demand is to take money out of people's pockets by having them be unemployed. And additionally, the more people who are unemployed, the more power employers have, which means they don't have to pay as much money, which means inflation comes down. And so that's been his biggest stumbling block. If he continues to focus on that, I think people are gonna be like, oh no, he's actually continuing to eyeball this, but I think, it is a week before Christmas. I think it feels good for everybody to have the market up. I think the idea is to get out of 2022 and into 2023. And if, adjustments need to be made, then he'll make them. But, call me a bummer, but I still think that there's a lot further we're going to go on rates, which in the long term helps everybody, because the more bonds we can buy at 4, 5, 6% for people who are in retirement or people who are looking to retire, we can lock in for a long period of time on those, the better, because for the last 10 years, that hasn't been a possibility. I mean, the risk-free rate is so high, it's unbelievable. And it's great for people because you can say, hey, I can make 4% and take no risk, none, which is excellent.
Yeah. If you want a good Christmas movie about getting the markets up for Christmas, watch Bobby Valentine's scene with the Duke brothers early in the movie Trading Places, talking about the traders wanting to get the market up.
Has Trading Places been canceled yet? It seems like a very cancelable movie.
It's a great movie, though. I mean, it's one of the best, definitely top 5. I might even be Mount Rushmore for me of finance movies all time.
It's definitely up there. I don't know. I'll have to think about that. We'll present that on Friday. I'm out for the call tomorrow because I'll be traveling for
We'll give you our
Finance.
Mount Rushmore of finance movies.
finance movies.
Yeah.
Yeah.
All elsewhere in central banks, Bank of Japan is considering a review next year of its monetary policy. Governor Haruhiko Kuroda ends his 10-year term in April. He's been unbelievably dovish doing QE infinity. He's been buying stocks for the last 10 years with printed money. So we'll see what happens with that. They may review policy, they may not. If they do review policy, the thinking is that it will be more hawkish and less dovish, i.e. less printing of money. And potentially stronger yen as a result. So we'll have to see what happens with that. But he doesn't finish until April, and I don't think that there will be a review until that time. But something to watch going forward. It may result in some strengthening of the yen in the interim. European inflation kind of following the path of US inflation. UK inflation was down a little bit from its very lofty levels from prior months. Its core inflation was down to 6.3% from 6.5%. It's very similar to the US numbers. The headline inflation was still at 10.7%, but that was largely because of energy. So if you look at core in the UK versus core in the US, they're very similar. And tomorrow, the Bank of England and the ECB both have their meetings. And the Bank of England has obviously been extremely out front with what they think of the economy. The ECB has been less so. So, Tom, as you look into those meetings, do you think that'll just be more of the same from the Federal Reserve and people will have some fatigue from the Jay Powell press conference? Or do you think that those will be market moving events in and of themselves?
I don't think any of themselves will be market moving events. I think that the Fed is obviously the flagship of the entire globe in terms of interest rate policy. That being said, if the ECB does something unexpected, say if they're massively dovish, they come in, they raise a quarter point instead of the expectation of 3/4. I think that could really make a splash, but I just don't think that's, in a bell curve of things that are possible to happen. I just don't think it's on the table at the moment.
Finally, on company news this morning, Delta Airlines provided their guidance for the year of 2023. Their operating margin is expected to almost double from 7.7% in 2022 to a range of 10 to 12% in 2023. So I guess that's more like 50% up. Much better than expected. Earnings per share, $5 to $6. Estimate was less than $5. So well better there. Revenue better than expected. It remains to be seen whether this is a capacity story, adding more planes, or if it is a revenue per seat story. And I think it's a mixture of both. What I would say is that I think it is probably more of a capacity issue and a scale issue. And basically, they just see there's so much demand right now, so much momentum. They're going to add seats and they're going to add them at higher prices. And that will build efficiency in the network. Their costs are normalizing a little bit, and they expect to have significant profitability as a result. They say that Delta's momentum is building. So I think that's very good news for Delta Airlines. The stock's only up about 4.5% today. I think similar to Southwest, I just don't know if people believe this. Personally, I'm still waiting on my refund check for my taxpayer bailout of Delta back in 2020, but I don't think that'll happen. I think my rebate will come in the form of higher prices.
Yeah, I think that's really, it's awesome for Delta. Great job. We don't own a lot of Delta. I don't think any. I don't own any. I don't think for clients that I don't think I ever will. But the question is, why shouldn't they be making more money if they basically have no downside risk? If you can't go bankrupt, shouldn't numbers be better? If you got the massive bailout, having had to book a couple flights here in the last couple of weeks, prices are astronomically high and it's almost prohibitively expensive, and I think that, I don't know, I've talked a lot about the airlines over the last couple of years on this call, and I just think this is shady. I don't know. I don't love it, but I think they need to add capacity. I think they need to bring prices down. I think that,
I think they're going to do one of those things.
Yeah.
I think they're going to add capacity, and I think they're going to raise prices.
Flights to, I talked about this on the call, trying to go down to the Orange Bowl and flights to Miami. It's $1,000 a ticket for a 2-hour flight to Miami that there are 10 of them a day. So we're flying into West Palm Beach, in which there's 2 flights a day because it's, 25% of the cost. But I don't know. It's ridiculous, I think. I don't know. I hate the airlines. That's how it is.
So with that, we will leave it there. We'll talk tomorrow a lot about the Federal Reserve. I guess all the central banks again. So you get part 2, and I guess I'll be doing it solo with Tom out. So bear with me, but it'll be a good show. Maybe we'll get someone else in here as a
Yeah,
guest
look forward
appearance.
to Mount Rushmore's on Friday.
Yep. All right. Have a great day, everybody, and we'll see you tomorrow.